China is no longer exporting silver. And not only that, well, I mean, under existing contracts, there's some export going on. But if you look at this year, the imports have been at a record level. In the first quarter, she imported, I think it was 1,628 tons. And we're beginning to get figures, there was a figure coming out of London, which I think was something like 320 odd tons, something like that, for April. We've got to get figures out of the other nations' export figures as well. But you can see that this whole thing has changed, it's turned around, and there is now a squeeze on the markets. When the price has fallen, guess what? China has increased its purchases of silver. I mean, I think March was a record month. So this is what's going on. And this is essentially an industrial story.
Silver is being framed as a physical supply story, not just another chart trade. The strongest warning is that Western paper pricing may be losing touch with where real metal is actually moving. Alasdair Macleod, a respected monetary analyst known for his focus on sound money, fiat currency risk, and precious metals markets, argues that silver's recent pressure should be viewed in the context of China's evolving role from exporter to aggressive importer. The shift matters because China has spent years refining, stockpiling, and controlling silver flows while industrial demand kept tightening the market. Once silver was treated as a critical mineral by the United States, China's willingness to supply the West appears to have changed sharply. Record imports, reduced exports, and a lease rate spike in London all point to a market caught short of physical metal. If gold moves back above $5,000 as the dollar weakens, investment demand for silver could surge into a market already drained of liquidity. That creates the setup for a much higher silver price. For patient buyers, the pullbacks look more like accumulation windows than lasting final breakdowns yet. Now, we present the clips from Alasdair Macleod's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Silver's quite different because predominantly the silver shortage is due to industrial demand. It's interesting because if you go back to, well, I suppose going back quite a way. I mean, I think it was in about 2013. I was speaking at a conference in New York, and this was attended by a load of silver juniors, who are obviously all in the business of trying to get people to invest in their stocks and raise money, whatever. But at that time, the sort of chat amongst the gold and silver bugs was, JP Morgan was screwing the market. They were shorting it and they were, killing it and all this sort of conspiratorial stuff. But then Blythe Masters, who was head of the commodity division at that time, actually went on television. I mean, I think these stories got to her a little bit. And she went on television and denied it. Now, someone of that ability and standing does not tell a barefaced lie on television. So what she said was right. I mean, it had to be. She said that JP Morgan do not take positions in commodity markets. They will deal, if you like, on the other side of their clients' positions. So where they act as agent as opposed to principal, where they act as principal as opposed to agent, then yes, but it comes to exactly the same thing. So armed with this knowledge, I thought I would go and talk to these silver miners and see, well, just one basic question. You mine this stuff. How do you turn it into cash to pay your running expenses, the miners and the energy costs and all the rest of it? And they all said virtually the same thing. The man from Glencore comes round, values the doré, and then the money is transferred into our bank account at their order, which presumably would be, guess who, JP Morgan. So the next question was, do you know where this doré goes? And they say, no, it's collected and then it's sent off for refining. Do you know where it's being refined? Well, we don't really know, but I suspect China. And indeed, China is a major refiner of silver and has been for a long time. So what was, the other side of the deal, obviously, was China was effectively obtaining this doré very, very cheaply by selling it forward on COMEX or in London or wherever. And which bank was acting for them? Well, guess what? JP Morgan. So you could see that this was actually a very, very clever scheme by the Chinese to obtain silver doré at low prices because they controlled the price. They controlled the market, in effect, through their bankers, who happened to be JP Morgan. And accumulated a whole load of silver as a result. Now, on top of that, of course, they are the largest refiner in the world of non-ferrous ores, particularly copper and also nickel, from which 56% of the world's mined silver actually comes out of that process. So, I mean, China has been accumulating a huge quantity of silver for a long time. They continue to suppress the price. I mean, if you look at the numbers in terms of exports, which I took the trouble before we came on the air to have a look at, in 2024, she imported 3,700, which I think was probably mainly doré and stuff, and exported about 5,000 tons. There's a bit of a sort of variation of things. So the balance was net exports, we reckon, of about 1,700 tons. In 2025, and the thing changed in September, but which I'll come to in a second. In 2025, her imports were about 250 tons. Her exports were 5,100 tons, meaning that she was a net exporter of 4,850 tons. Now, the thing that's interesting about that is that until President Trump decided in a bit of a hissy fit, he said, I can't remember quite what it was, but he said, right, if that's your attitude, we're going to put 100% tariffs on Chinese exports. To which China then turned around and said, well, if that's your attitude, you're not getting any rare earths, full stop. What we didn't know at the time, but circumstances showed that this was the case. What we didn't know at the time was that the Chinese not only took this view on rare earths, but also on silver. And this is particularly important because it was at that time that America decided to categorize silver as a critical mineral. So was China going to supply America with silver, having declared it was a critical mineral, and from the government's point of view, vital for the production of weaponry? Obviously not. So this was late September last year. We then move on to October the 7th, October the 9th, I think it was, in London. Suddenly the lease rate shot up to 40%. And there was a huge great crisis which had to be smoothed over. Why? Because suddenly the market was caught short of this supply, which had been flooding into the market at the rate until that happened of approximately, I mean, at a net figure, approximately 5,500 to 6,000 tons a year. So this was a big, big change. China is no longer exporting silver. And not only that, well, I mean, under existing contracts, there's some export going on. But if you look at this year, the imports have been at a record level. In the first quarter, she imported, I think it was 1,628 tons. And we're beginning to get figures, there was a figure coming out of London, which I think was something like 320 odd tons, something like that, for April. We've got to get figures out of the other nations' export figures as well. But you can see that this whole thing has changed, it's turned around, and there is now a squeeze on the markets. When the price has fallen, guess what? China has increased its purchases of silver. I mean, I think March was a record month. So this is what's going on. And this is essentially an industrial story. Now, if we can imagine that, and we can be pretty certain this is going to happen, but just imagine it for a moment, that the price of gold goes up. In other words, because the dollar's tanking. Price of gold goes up, and we start looking at over $5,000 again for an ounce of gold. Then I think you'll find that demand for silver from investors is going to take off. At the same time, when China has just drained the global markets of silver liquidity, physical silver liquidity. Where's it going to go? How high is the question which follows that one. So that's my view on silver, for what it is worth.
The industrial case is central. Silver is tied closely to copper and nickel because much of the mined silver comes from those ores, and its uses overlap in electrification, electronics, electric vehicles, and photovoltaics. Copper and nickel have already pushed strongly higher, so silver lagging behind looks less like weakness and more like delayed recognition. China's 13% VAT structure on imported silver also makes the market harder to arbitrage. If Shanghai buyers are still prepared to pay more despite that tax, it signals stronger physical demand than paper prices in London or COMEX suggest. The practical prediction is that silver continues draining from the West toward Asia, and any sharp price weakness becomes an opportunity for physical buyers rather than proof that demand has disappeared. That is why dips should be judged against inventories, not only headlines or futures charts now. Now, let's get back to the interview.
Imported silver going into the Shanghai gold exchange and also the futures exchange, has to bear a 13% VAT, value-added tax. So immediately you have got a tax differential there, as it were. Now, having said that, if the price is going to reflect that additional value, then quite obviously there is demand at that higher level in Shanghai than there is, if you like, on COMEX or in America or in London. So the point is that this tax basically means that you can't arbitrage it. You can't sell in one center and buy in the other. That's the definition of an arbitrage. But it does mean that as far as the Chinese are concerned, they are prepared to pay a higher price for silver, notwithstanding that some of it goes in tax, which basically is going to lead to a continual drain out of the West. So it's slightly more complicated than an arbitrage situation. But yes, you are right to point that out. This is not a panic. Basically what's happening is that I think the Chinese authorities mainly, who handle silver imports, they're basically, they've just turned around and they want to deny not just rare earths, but silver to America, now that America reckons it's a critical mineral. It's all part of that situation. As I say, this is, we're talking about something which is really, it's been in deficit for the last 7 years. That deficit has been made up by China. If you look at the metal focus numbers, the assumption is that the deficit is made up out of investment, silver held for investment. No, it's China's stockpile. Because they've been able to stockpile it at a more rapid rate than they've had to sell it into the market to try and suppress the price. They've managed the market brilliantly, probably with JP Morgan's help. I'm not saying that they're doing that now, but that was certainly the situation earlier on. And basically we're out of silver. And the other way to look at this, Danny, is that copper and nickel are at new highs. They've more or less doubled over the last 12 months or so. Now, silver had its run early, admittedly, but with particularly copper and nickel running ahead in recent months, you would think it would take silver with them, not just because, most silver actually comes out of those ores, the ores for those two non-ferrous metals, but also from the point of view of use, particularly with copper. Virtually all copper's uses are in line with silver. They're twin. They're joined at the hip technologically, electrics, everything else. Right. EVs and so on and so forth. I think silver's got the additional thing of photovoltaics, obviously, but you can see that there is a commonality in markets there. So why is silver, being left behind? I think the answer perhaps is that we've driven the speculators out of it. Just look at the level of open interest on COMEX. It's at 20 years lows. It's beginning to pick up a little bit, actually. That, I think, tells us that the speculators aren't playing this at all. They've been discouraged, I think, by the bullion banks and the market makers, who basically are short and can't see how they're going to close their positions, because they can see this too, what I'm describing. We got the same thing in the gold contract. They can't close their short positions. In the past, with the gold contract, at least you could sort of cover yourself in London. You'd be short on COMEX, long in London, but we're talking about paper short, paper long, rather than physical. No bank wants physical. It's you don't want it really. So, the physical, I think the paper markets are basically failing in terms of acting as a market. And we see the same thing in oil as well. The oil futures don't really reflect the situation in Asia. And we're seeing the price fall on news. Okay, fine. But the open interest is very, very low. So the speculators aren't in there. They should be. Under normal circumstances, you would see hedge funds saying, well, hold on a minute. Here is the arbitrage. It's underpriced on COMEX, overpriced in Asia. What we should be doing is buying the futures here and selling them somewhere else where we can find a paper equivalent, whatever, which may be, let's say, an off-market deal or something like that.
The paper market warning is just as important as the supply warning. COMEX open interest is near multi-decade lows, which suggests speculators have largely been pushed out. That may look bearish on the surface, but it also means the market has fewer weak speculative longs left to sell. At the same time, bullion banks and market makers that are short may find it increasingly difficult to close positions if physical silver is scarce and Asian demand continues to absorb supply. This creates a fragile structure in which paper prices can remain subdued for a while the physical market continues to tighten beneath. If gold rises as the dollar weakens, silver could attract both monetary and industrial demand. That combination is powerful because it hits a market already described as short of liquidity. The strongest prediction is that silver eventually catches up with copper, nickel, and gold, but not gently. A repricing could be sudden once investors realize the shortage is not temporary. China is no longer filling Western deficits, and paper contracts cannot easily replace available metal. In that moment, silver may move from an ignored industrial input to a strategic monetary asset quickly, rewarding patient holders before consensus catches up. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.